Even though interest rates haven't dropped in the US, we are seeing liquidity kind of come back to the markets a little bit. So I think crypto is an incredible indication of liquidity. It's the most sensitive asset class to global liquidity. So when you see crypto rising or falling for that matter, it tends to be a pretty good indicator of what's happening.
Agreed.
Global liquidity, because it tends to find its way into crypto.
But nobody has got a crystal ball, so I might be wrong as well. However, I think that we're going to see a pause in interest rates. So neither an increase and neither a decrease, at least till May of next year, because there's always a lagging effect to the economy when interest rates rise, especially in the speed, the way it has done by the Fed. Michael, we're back for the second episode of The Rundown. Welcome, everyone. How are you today?
I'm doing great, Shiv. There's some pretty good sentiment out there on crypto Twitter. Less people fighting with each other, I think. So I think Gary Gensler's back at it. We saw some news yesterday with Kraken, but no, I'm doing great. How are you?
Pretty good, man. Pretty good. I'm so glad that I've got a crypto Twitter whisperer now, because I don't think one person can be a crypto Twitter whisperer. They need either a lot of bots or they need a team. So I'm glad we both are keeping track of what's happening among the tribalism that we witness in crypto Twitter.
It's so true, right? Because we're both, for the people that aren't as familiar with Shiv and I, we're on LinkedIn primarily.
Yeah, that's true.
And
the uncool
it's a little bit quieter.
People.
It's a little bit quieter. We're not part of the Twitter mafia over there, but you certainly have to pay attention to what's happening on Twitter as well. That's where most of the conversation is happening in crypto. So it's certainly good to have some eyeballs on what's happening over there.
Absolutely, man. So why don't we just kickstart? What is happening in crypto in the last 1 week, man? 1 week in crypto is like a month in traditional finance. So what has been happening this past 1 week?
There's a lot going on. I think a lot of the questions that people are wondering, and we've seen like a pretty substantial move from Bitcoin and crypto, even a lot of the altcoins over the last, let's say 2, 3, 4 weeks or so, is like, has there been a major structural change in the market? Is crypto winter over? Are we going into like another period of price discovery, adoption, bull market type vibes? I'm curious to get your thoughts on this, but I guess from my view, and I actually put a post up on LinkedIn about this where I said we've been in a bull market for a year now, and nobody agreed with me on that. But it was really me just looking at the price action from when Bitcoin bottomed around this time last year. It's amazing to think that the FTX fiasco was only 1 year ago now, but Bitcoin is up, about 130% over the last year. So if you were just sort of looking at that, you'd say that looks like kind of a bull market. However, the other stats that you would look at in terms of, market structure indicate that we're not reaching that like hype phase in the market just yet. When you look at trading liquidity, when you look at Google searches, like YouTube views, all the kind of retail like sentiment indicators, I would say are still pretty low, which tells me that this move we've seen is actually primarily institutional buyers in the market. And we can kind of see that in some of the flows. I was looking at some CME data, CMA futures past Binance recently, which indicates that there's some institutional buying in there. We've seen like some massive premiums on grayscale products for like Solana and Chainlink, which we'll go into a little bit more later. But looks to me like you have some institutional buying, maybe some front running of Bitcoin ETF, which looks like we should have an answer hopefully in the next few months. But I'm not ready to say that we're going to go into this phase where it's another 2021 type cycle just yet. I'm curious to get your thoughts on what you're seeing out there though.
Yeah, look, this is why I'm so excited that we are the world's first crypto fundamentals educational podcast, because later on during our episode, we're going to do our first going on chain with token terminal, where we're going to deep dive on the fundamentals as to why both you and I can't say strong conviction that we have started the bull market, because we're not seeing that fundamentals signal that we generally see in the past bull cycles. So I'm looking forward to it as well. And yeah, look, I also agree with you. I think it's great. The above 100% increase in price that we've seen in not only Bitcoin, but also in Ethereum, because Ethereum was less than $1,000 at one stage, and now it has crossed $2,000. So both those big assets have gone up by more than 100% this year. So from a TradFi lens, somebody would say that you got to be crazy not to call this a bull market. You've doubled it. But from a crypto lens, and being somebody, both of us have been combined more than 13, 14 years in this asset class, I think it's more that it was undervalued significantly because of the events that happened late last year in November with FTX. All that panic and all that liquidity getting flushed out caused all the Bitcoin and Ethereum just to crash. And so I think it was undervalued, and that's why we're seeing somewhat of a correction, that it has reached that level. But yeah, having the experience that we both have, I'll speak for myself. I also would say that it's too soon to call it the crypto bull market that we are used to, like in the 2020, 2021 phase. So that's where we're excited that we're going to go to the fundamental analysis and share with our listeners and viewers as well on what we actually mean. So looking forward to that.
Yeah, I think I would agree. Like it feels like we're if we are going into like a new sort of era of price discovery, we're probably in the first inning, of that period. And like when you look at some of the activity as well.
And I just want to say that it's the first innings of a baseball game, because we've got some viewers from India as well. And over there, cricket is more popular and there are only 2 innings. So the first innings of a 9 innings baseball game. Yes.
There you go. Thank you for that. Yeah, thank you for that. We do have a much larger audience that I'm aware of sometimes. So, okay. Yeah, first inning of the baseball game. When you look at some of the charts, like comparing to sort of last cycle, you can sort of see some similarities to like the mid 2019 period after, like you said, Bitcoin crashed down to like 3,800 or so at the end of 2018, and it was probably undervalued. And you actually saw it get up to about 14,000 by mid 2019, which that looks like a bull market, but you didn't really have like new interest from new retail traders coming in and what you would typically see in like a real full-on bull market. And I feel like we're kind of in one of those periods. And then, of course, the macro situation out there. I'm curious to get your thoughts on how you think about that. If you're investing in crypto, and this is the topic we'll touch on a lot in this podcast, you need to have an idea of what's happening in the macro world as well. Inflation, has been kind of coming off a little bit. We've seen the Fed pause for now. I think there's 2 schools of thought that we may see interest rates continue to rise and higher for longer. And then the other school of thought is that, interest rates can only stay there for so long because of the fiscal situation in the United States, the amount of interest that we're paying on the debt, and just kind of what this means for the economy moving forward, where, in my opinion, the economy in the long run does need lower interest rates. So I'm curious, just from the macro perspective, how do you think about macro? There's obviously some dark clouds in the sky. Is this something that you have to factor into how you think about whether or not you're investing in or allocating to crypto today, or do you wait for the Fed to sort of make a move? I'm curious how that factors in and what you think the macro outlook kind of looks like.
Yeah, absolutely. Look, thanks a lot for asking me this question first, Michael, because I am a macro investor. Whether I invest in startups, whether I invest in crypto, or whether I invest in public equity, I'll always look at global macro first. Look, I think you are right. U.S. economy is pretty resilient. I've actually been surprised. It's been pretty resilient. If you look at purely from an interest rate perspective, I think it's very soon to suggest that we're going to see a decrease in interest rate, like a lot of pundits from Wall Street journals that I've been reading have been suggesting that it's near decline in interest rate, maybe not this year in December, but maybe early next year. I disagree, but nobody has got a crystal ball, so I might be wrong as well. However, I think that we're going to see a pause in interest rates, so neither an increase and neither a decrease, at least till May of next year, because there's always a lagging effect to the economy when interest rates rise, especially in the speed, the way it has done by the Fed. So we haven't witnessed that lagging impact onto the job market, because the job market in US is still doing very well. I think Fed or Chairman Powell, I think he's playing the waiting approach. And of course, we can only speculate, which is, by the way, the weird thing that I find about, just the central banking system. They are not crystal clear about when they give their speeches. They're always very cryptic. So in the last, this November announcement that happened about pausing the interest rate, Chairman Powell, I think he said somewhere on the grounds that we haven't removed the possibility of increasing the interest rate. So look, that's a good sign. So that to me, when I hear, is like, okay, it's too soon to suggest that there is going to be a decrease of interest rate, since Chairman Powell is suggesting that we're not removing the possibility of increasing the interest rate. So that just removes that possibility that they're going to decrease the interest rate anytime soon. But I'm speculating that they do not want to increase the interest rate because they don't want a run off the bank like how It happened with Silicon Valley Bank. And the US banking system, in my humble opinion, is still very fragile, especially the regional banks still. We do not want to see a decrease in interest rate because I feel like the economy is still doing well and inflation hasn't reached that 2 to 3% level, which the Fed always targets. So that's my opinion.
I think that's very fair. And it's hard to imagine a pivot in interest rates unless, like you said, the US economy is still pretty strong. Unemployment rates are pretty low right now. It has been, I think, surprisingly resilient to this rate hike. And like I've seen some people now looking at what's happening and almost viewing almost as stimulus. The fact that we're paying out 5%, you're sort of stimulating the economy in some ways. And then I saw a podcast last week that was looking at just global liquidity conditions.
Yeah.
And you can see that China has actually dropped their interest rates. Central bank has intervened. So we're seeing liquidity conditions change out of China. And then on the margin, you're seeing it change. Even though interest rates haven't dropped in the US, we are seeing liquidity kind of come back to the markets a little bit. So I think crypto is an incredible indication of liquidity. It's the most sensitive asset class to global liquidity. So when you see crypto rising, or falling for that matter, it tends to be a pretty good indicator of what's happening.
Agreed.
Global liquidity, because it tends to find its way into crypto. So yeah, I think that's probably one last thing, maybe just kind of stuff that's going on. Like we saw the Kraken story yesterday. It looks like it's the same story as with Coinbase, that, Kraken's listing unregistered securities on the exchange. Curious to get your thoughts on this, timing of it. Like, why did they wait so long after Coinbase? I don't know. Any thoughts on that?
So look, I recently had a conversation with one of the top C-suite executives of a large stablecoin issuer who happens to be an NYU Stern alumni. So that's why we got connected. He deals a lot with US regulators because he's based in Washington. And I asked him the question, people who are in this position, they are obviously smart. That's why they are in this position. It's ignorant for people to think. It's very ignorant for people to think that people who have got positional power are dumb. They are not dumb. There might be other agenda. There might be some favors that they got to do, whatever it is. But the reason why they make the decisions is not because they are dumb. They might be ignorant about it, but it's not because they are not smart. I just want to make that clear. So yeah, I asked the question that why are they taking their time in bringing clarity? Why are they hip-hopping, with the decision-making process? And by the way, it's not just in US. I think we were having a discussion recently. Something happened in Australia as well, where they came out with the announcement that wrapped and unwrapped of tokens are going to be a capital gains taxable event. I mean, anybody who does anything with DeFi knows how ridiculous that sounds. But that's the thing. It's happening in advanced economies still, so it's not limited to US. And also, I'd like to give the benefit of the doubt. It's not happening because people are not intelligent about this topic. They might be ignorant about it, or they might have got other agenda, but they're not dumb about it. That's my humble opinion. Yeah. So coming back to the discussion that I had with the C-suite, I asked him, what is the problem? And he gave me a very good answer, which I feel would add value to our listeners. He said that the regulators everywhere, they are having three approaches. Let crypto industry burn to the ground by itself, which have been proven last year that we as an industry has the potential to do it. Three Arrows Capital, FTX, Celsius, Terra Luna, goes on and on. So that's one thought among the regulators, that we are the status quo. Let the crypto industry burn to the ground by itself. The other one is that let us contain it. And that's what we are seeing with what's happening with Kraken, which is their attempt to contain it, which is what they were trying to do with Coinbase as well. The third is, and that's what the crypto industry or a lot of people who came from Wall Street to crypto now are trying to pitch to the regulators, is that let's regulate it thoughtfully. And one of the points that comes out from it, and it's something that you brought up as well, I've noticed in your recent post, in order for SEC to regulate crypto, you need to allow them to hold it, but also have some clauses where they can't misuse that holding pattern as well. SEC people, they can hold equities, right? And they regulate the securities market as well. But they are told to regulate an asset class, which they are told not to hold. So it creates an inherent bias to them that there must be something wrong in it. There is no incentive for them to learn and stuff. So I think there needs to be something done in order to create that incentive where they get educated and see crypto asset class the same way as a securities asset class. So there is still a lot of education work to be involved and a lot of, just that relationship building.
100%. Yeah, that's a really good point. I did see that in the news that the SEC is having trouble hiring because of this problem, because you can't hold crypto and work at the SEC. And yeah, I think I put a post up, sort of just a playful post on LinkedIn about how to deal with like crypto skeptics, especially with the holiday seasons coming up and everyone's going to see their family members, and if you work in crypto, you get that question. Like my family will be like, how's Bitcoin going? That type of thing.
Yeah.
If you've never used a crypto product, right? If you've never used a wallet, how could you possibly have an opinion on the asset class? Never mind regulate it. If you can't hold the asset, you're not using a wallet, you're not engaging with any of the products or services available in DeFi or any of these other areas of the ecosystem. That seems really silly. Imagine if you were like a financial analyst and you weren't allowed to like access data. Like, how would you do your job? It just seems kind of crazy. But, that news story, it's kind of interesting to see it hit again now that crypto had like a little bit of a positive run over the last month or so.
Yeah.
And you're kind of in like the market structures have sort of changed when like negative news like that doesn't really do much in terms of like the markets. I think there might have been a little bit of turmoil with the Kraken news, but nothing significant. We're probably going to go through a period now where bad news is good news, and that's kind of how that the market structure has changed a little bit.
Yeah, and just quickly, since you're saying that bad news and good news, I just want to bring the point about the recent news that we heard that DOJ is thinking about settling the case with Binance and getting $4 billion and dropping the charges. Firstly, that's a huge amount. Like, that's is that the biggest amount, like, from a crypto company? That's the biggest amount, right?
Oh, yeah, it's got to be. I think this happens a lot in traditional finance.
Yeah,
like, you see massive fines like this. But yeah, that is a massive fine for a crypto company. It looks almost extortionate. Like, it's almost like, I grew up, outside Boston, and, I think the Irish mafia would be tipping their hat to that one.
Yeah.
But yeah, it's fascinating that, they can just come in and basically say, yeah, give us $4 billion and, you can keep running your company. So.
Yeah. So the reason why I brought that up is that a lot of people might say that is bad news. So that means that Binance did something dodgy, right? That's why they're fining them a hefty amount. So a lot of people might say that is bad news, but it seems like that is good news without having any data. But I like to believe that they are stashed with a lot of money since they dominated the trading volume for crypto globally for years. Just so that you know that there is a very small Australian crypto exchange called CoinSpot, by the way, which nobody outside Australia would have heard of it. They released their financials and they made a profit of $300 million US, a year profit of $300 million US dollars. An Australian crypto exchange. Australia is a small country. We don't have many Australians in the world. It's only 25 million. And out of that, only 20% probably, trade crypto. So that just means that it's less than 5 million. Serving the customer base of 5 million without having Rails in the background with Binance and so forth, they can make profit of $300 million. I like to believe Binance has made like a lot of billions of dollars. So for them, giving $4 billion doesn't mean much, but that's good news.
I agree with you on both points. Like, they can pay that fine, and then it's been good. The market's like, okay, we can move forward now. And like, I think the BNB token was up with that news going out. So I do think it's seen as a positive. Similar, it's interesting to me too that this rally that we've seen has coincided with the end of the FTX and Sam Bankman-Fried free trial as well. Like, okay, we're moving on now, and the industry's kind of had its cleansing moment, hopefully. You never know with crypto. But yeah, I think that's super positive. It's interesting to me because I think the perception in the US about Binance is similar to how you might think about FTX. However, like, when I talk to people, we have an analyst that's in Hong Kong, and Binance is primarily serving the Asian market.
Yeah.
And that is the number one. That is Coinbase for the Asian market. I think people in the US view Binance as almost like this scam exchange, but that is what everyone is using in massive markets on the other side of the world. And so they are very important.
Binance, fortunately, unfortunately, however you want to phrase it, they are basically the dominant player in crypto at a global lens. Yeah, I know Coinbase is huge in US. Crypto.com is another player that is huge at a global level, but Binance is just trumps everybody else. Binance is number one, and then there is the rest. And especially a lot of people who are listening who might be new to crypto or who might have just started crypto, they see just the retail trading volume. And that is fair. Binance has got a lot of retail trading volume, but there is also the element where there is a lot of exchanges that are catering to one country. Like, for example, the example that I gave, CoinSpot. It caters to Australian market by providing those Australian dollar rails and Australian KYC, but it uses at the back end market makers or institutional liquidity providers, which contains a lot of it from Binance as well. Binance plays a huge role, not only in retail trading, but also in institutional trading, and all the other exchanges that you see in other countries, they provide that liquidity to them. So massive player.
Yeah, I think from the SEC's perspective, they want to regulate companies that they're familiar with, they're comfortable with. And so like having somebody like BlackRock come into the space, that is much easier for them to, they're very familiar with dealing with companies like BlackRock. And so that's how you get a little bit more maturity of the crypto space, at least in the US. It'll be interesting to see how that impacts, you know, the Binances, the Coinbases of the world. There is a relationship with BlackRock and Coinbase for like the ETF and things like that. But the market structure starts to change once Wall Street gets involved. And so it'd be interesting to see how Binance fits into that as well moving forward.
Now, before we move on towards the institutional interest in Solana, which I know that you would love to talk about as well, and I would like to learn more about as well, I just want to quickly ask you, and that's the benefit of having our arrangement of doing this podcast, because we bring a truly unbiased global lens to the perspective. And I want to ask you this question, and if I don't ask, I'm not going to do justice for this arrangement. According to you, I wouldn't use the word attack, because if somebody is getting fined $4 billion, there's probably enough meat to find them. But how much of going after Binance is driven because of the geopolitical events between US and China?
It's an interesting question. I have no idea, but I do know that feels like there's increasing tension. Biden was actually in China and met with Xi recently. You do wonder, that it plays a role. I mean, technology certainly plays a role in geopolitics, and I think AI is actually a big part of that discussion as well. You'd have to think there's something there. Is this something you've thought about much?
I'll tell you this thing. I try to explain this to my friends in India as well, who are very gung-ho and positive that soon US dollar reserve currency is going to go down. And I'm like, you just absolutely have no clue of the global financial system and the stronghold the Wall Street complex has over the global financial system. The global financial system, which includes a lot of derivatives that not many people even know about, which runs in trillions of dollars, they all run through the Wall Street investment banks. China knows one thing. While they are starting to make attempts in order to create their own financial behemoths, whether it's in trade or something, in order to replace the Wall Street financial system of this global TradFi system that they have, it's a century's task. It's so complex. It's so interconnected. It's so powerful, the Wall Street machinery, that it's not going to go anytime soon. So forget about US dollar reserve currency going away anytime soon. So because of that, BlackRock coming into Bitcoin and noticing the crypto is the future asset class, and so far, the institutional trading of crypto is done on mostly non-American exchanges, that now with BlackRock coming in, and we are hearing a lot of other investment banks also working on creating a digital assets retail exchange, it's probably a way for US regulatory body to protect the status quo of including the new asset classes into the Wall Street machinery. That's what I think, connecting all the dots, and given my training in history of finance. But a lot of people might just say I'm a conspiracy theorist as well, which it's okay if they want to troll. But that's how I see it playing out.
Yeah, that's interesting. Do you have any concerns with, we've seen this from the Bitcoin community a little bit with BlackRock coming in, and I think they have some investments with some of the Bitcoin miners as well. What are your thoughts there? Do you think there's any chance, should we be worried that BlackRock could potentially get to a place where they can exert influence on Bitcoin miners we've seen some data with I think there's 2 Bitcoin mining pools that control more than 50% of the hash rate.
Yes. True.
And I think BlackRock may be an investor in some of those mining companies. So yeah, curious, is this something that worries you or?
Yeah, look, good question. And it's honestly a question that a lot of my students also ask, not related to BlackRock, but ask that Bitcoin doesn't have that much of a market cap. What if a lot of family offices, all of them combined with a single agenda to stop decentralized Bitcoin, come in, pool their money and buy all these miners and create a 51% attack, or just in the background decide not to showcase and let the Bitcoin run as a 51% owned commodity, but they earning the dividends? And look, I've thought about it for many years, and my answer is that firstly, I hope it never happens. If it happens, it's going to be a very expensive affair. It's not going to take, it's going to take like $500 billion at least to make that happen.
Right.
So it's not going to be an easy thing. And if that happens, I'm not going to go into the semantics like some of the podcast people do. But if it happens, I think people are going to be smart enough. And I don't think Bitcoin will be considered a decentralized currency or decentralized commodity in anymore. And that investment is not going to be fruitful. If that investment was done in order to get control of Bitcoin, to crush Bitcoin, then maybe, yes, it's going to work. But eventually, when they, I guess, sell their stock, new miners are going to come in with better hash rates. I think the game theory perspective and the incentive system of Bitcoin, to me, is bulletproof, that there might be short-term attacks by ownership or 51% attack, but in the medium to long term, it will rise up back again. Just like how the banning of Bitcoin by China brought the hash rate from China from 80% to single digits, and majority of them went to US and Canada. Bitcoin is bulletproof to me. Short-term attacks, it could happen, but medium to long term, it will be immune from that.
I think that's kind of where I come in as well. It's not really a concern for me because, like you said, if you game out incentive structure of this, anybody could potentially try to take control of the network. But and I've seen people raise this concern of like, well, the miners could do that, and sure they could, but they would, in the process, they would be killing all of this investment that they made, and wouldn't make sense for what? For one, reorg and double spend. It doesn't make sense. The economics don't make sense.
Absolutely. And just on that, I want to make a quick point. A lot of people might not be tracking this. I'm actually definitely telling this thesis to a lot of my friends, whether it's in Australia or India, to open their mind and think about Bitcoin not only as an asset class, but as a geopolitical asset as well. Middle Eastern countries, Oman, Bahrain, Dubai, we already know does it, like the UAE, but soon Saudi Arabia. All these countries are actively now thinking about or have already invested billions of dollars in setting up Bitcoin mining operations. And these are state-sponsored funding. So what does that mean? It means that they also feel that this is very important asset class or energy resource or whatever you want to call it, military asset for them. Middle East has got a lot of money. All those Silicon Valley people, whether it's A16Z and all, they're all going to Middle East to set up a base or get, those royal families' money. So I think the point that BlackRock is going to buy out the miners, sure, but we're going to see state-sponsored miners that are coming in because this theory about Bitcoin being a geopolitical asset in addition to a financial asset is now gaining steam.
Yeah, and that's probably a rabbit hole discussion. I think we could probably go deep into this because my thesis for Bitcoin mining is that it's going to converge with the energy industry.
I agree.
And that's the long term.
Episode one day.
Yeah, special episode. We'll come back to that at some point.
Yeah. So look, Michael, you're right. We've spoken a lot about this and we can go in circles and do a special episode about that. Let's talk about the institutional interest flowing in Solana. We haven't spoken much about Solana. Second episode, let's do a little bit of Solana digging as well. Fantastic.
Yeah, there's been quite a bit of interest, and anybody who's been following the crypto markets has seen the price of Solana shoot up recently. And, I think it bottomed in really the $8 range. And this was almost towards the end of last year, going into the beginning of this year. And people that are interested, I wrote about the Solana network right as the kind of year turned. It was kind of when the market was bottoming a little bit. And there was a lot of just really nasty sentiment out there on crypto Twitter towards the Solana community. You had this moment, it reminded me of Bitcoin punching down on Ethereum in the 2018, 2019 period. And you got the same exact vibes from Ethereum this time, doing it to Solana, which Ethereum's the incumbent in this scenario and Solana's kind of the upstart. And just that's like a nice little tip for people out there. Like when you see this happening, it's usually a sign there's something there with the thing that people are punching down on. But no, I want to just bring people's attention to this chart. This is the Grayscale Solana Trust. So this is where people go to buy Solana if they have a brokerage account and some access to Solana or some other crypto assets. They don't want to set up an account at Coinbase or some other crypto exchange because you could simply go there and buy it. But this is just showing like this interest in Solana. If you look at this, the price of these assets right now for Solana, it's trading at $115.20 for one share of the Grayscale Solana Trust, which only holds 0.38% of Solana, right? So it's not even a full Solana. It's trading at $115. The market value of Solana is about, I don't know, what, $55 or something as we record this. And so you've got this thing trading at about a 500% premium to the price of Solana for people to get access. You know, it's kind of been interesting to see the interest in Solana. What I've seen from just the institutional flows are primarily going to Bitcoin and Solana. And Solana has been overbought for a period of time now. You would expect a pullback, but there's just there's some serious flows behind this. And so, yeah, I just wanted to bring this up. It's kind of interesting. It shows you kind of how investors are thinking about Solana. I think what's really going on here is they missed Ethereum. These are people that missed Ethereum last cycle. Ethereum went from 0 and then it went up to 1,500 in 2017. And then it came down to about $80 and then it went to 4,800. So about a 60x. And now Solana went from 0, didn't exist. And now it went up to 260 or so last cycle, all the way down to $8. So where does Solana go from here? And I think a lot of people are looking at Solana thinking whether it's true or not, that Solana is Ethereum last cycle. And that's why we're seeing all of this interest. Yeah, curious to get your reaction to the interest in Solana.
Yeah, look, I think your theory is probably the reason, because I remember in the 2020-2021 bull cycle, a lot of people got into Solana because of exactly the same reason. They missed out on Ethereum when it was $3, $4, or $15 before it jumped to $1,250, $1,300 during the 2017 bull cycle. So they thought that now if they can get Solana at $4 or $5, when Sam Bankman-Fried was going on and talking all about Solana, that I'll buy all your Solana bags for $3. A lot of people actually bought during that time thinking that it'll go to, $1,200, $1,500. It still went to, those $260, $270, $400 levels, which is still a lot of money and a lot of great returns. But then it went back to earth at $8 recently. So that could be the reason. You know what? I would really love to know, and I do not know how we would know unless we can bribe some of our friends at DCG in telling us who's buying all this, which they would never, and we will never disclose that information. But it'll be great if there is some public resource out there to let us know who are actually the buyers behind this, because this premium is insane. Like, I'm just putting it out there. Given that all the other digital currency trusts of Grayscale, they are running at a discount, this running at a premium, and at that level of premium, I just find it insane still.
It is fascinating. And like you said, the Bitcoin Trust is trading at a discount right now. Still, it's closed quite a bit recently, and it converts to an ETF. Like it should close to 0. But
can we see the Grayscale Bitcoin? Our viewers and listeners just see that comparison and get an understanding why we think this is crazy that this premium is happening.
So here you can see we have the opposite playing out with Bitcoin, where the market price per share within the trust is actually trading below the actual market value. And so this has been going on now for over a year. It was trading at a premium for a while, and it was the same idea where investors wanted access to Bitcoin during the bull market of 21. Again, they don't want to custody the assets. They don't want to use something like Coinbase or Binance or another exchange. So they get this access through their brokerage account and they pay a premium to do so. That premium flipped during the fallout of the last cycle, and it has yet to fully collapse back to 0. We expect this to collapse to 0. This should be converted to an ETF at some point. But yeah, that's a big difference from Solana there.
Yeah. So look, I hear that people would say that, oh, there's a BlackRock ETF that would be coming soon of Bitcoin. So that's why, there is still a discount over here, but Grayscale has won the case. This will eventually, become an ETF. I just think that that premium of Solana there is some story behind that. Are we going on chain now, Michael?
I think it's time to go on chain. It's time to go on chain with Token Terminal.
Amazing. Let's go on chain. Token Terminal. Yeah.
Here we are. We have made it into Token Terminal. And just to give people a quick little overview of on-chain data and what's going on here, Token Terminal is essentially running these nodes for all these various networks that they display data for. And what that allows us to do is essentially visualize the data that's available to the entire market. Token Terminals, you have to be somewhat technical to pull this off. You're relying on Token Terminal for that, but the data's out there. It's available for everyone. They've got a team of people that are going through this data and formatting it, structuring it in a way that we could easily analyze it and view it on these pretty dashboards. We were talking a little bit earlier about, are we in a bull market? What's happening in terms of market structure out there? You can always kind of just come in and look at trading volumes. This is Bitcoin trading volume last 365 days. So we can see, the price has been trending up in this range over here, but we're not seeing trading volumes getting to those levels where that there's been just new market entrants on a scale that you would see during a bull market. Even just going back, earlier this year, we saw volumes much, much higher. And if I zoom all the way out to maximum view here, we are still nowhere near what we would expect to see in a bull market. Right. So we would expect to see volumes getting into the $50-60 billion per day range. And right now we're still, floating around between 10 and 20 or so. Yeah, not a ton of liquidity out there. And it's the same idea on Ethereum. I'm going to pull up Ethereum's trading volumes here. It's really the same idea. It's kind of across. Crypto tends to move together, but same idea. Ethereum's volumes are up a little bit recently, but if you zoom out, once again, nowhere near where we expect to get. I'm curious, do you think we're going to surpass these numbers into the next cycle? What are you expecting this chart to look like in a year or so?
It should, right? Because if there is more activity on Ethereum, which one would expect there would be if the industry has matured, if there are more people wanting to do DeFi-related activities or NFT-related activities, that you would expect that this volume would increase. That is that fundamental layer to explore. However, if we don't see that and we still see the price increasing, then it probably also suggests that a lot to do is with TradFi people coming into it and not really doing activities on the Ethereum chain, but getting liquidity from traditional asset classes and storing it into, let's say, these Ethereum ETFs that are coming in, that are more of a buy and hold strategy. So that could be another element of why price is increasing, but we not surpassing these fundamental and indicators when it comes to trading volume.
Yeah, and I should probably clarify too, these trading volumes are more coming from the centralized exchanges, so not necessarily purely on-chain stuff. I'm going to flip this over so we can see just pure on-chain fees and kind of what that looks like in terms of what we've seen related to the price. They want to talk a little bit about this idea of crypto and the reflexivity of crypto and price and on-chain activity, because what we tend to see here, and I find this extremely fascinating, this is a concept that George Soros has written extensively about, this idea of reflexivity, and that it sort of challenges the idea of the efficient market hypothesis, which is that the market always knows, the market has perfect information and it's pricing things with that perfect information at all times. The theory of reflexivity looks at that and says, well, actually the market influences fundamentals. And so no, the market can't possibly know everything and have perfect information, because the market and market sentiment actually impacts fundamentals. And I see this in spades in crypto. And I think it's super fascinating, where what I tend to observe is that the price will move first. And then with price movement, you see more on-chain activity, right? So now in this chart, we're looking at the blue line is the price of Ethereum. And then these green bars are the daily fees on the network, that's pure on-chain data showing how many people are using Ethereum.
Yeah.
So the price goes first, and then all of a sudden you see more activity, which is really the fundamentals of the network.
Yeah.
And so I find it super fascinating. The way that this tends to play out is price moves first, and then you see people come on chain and they're going into dexes, they're trading, they're minting NFTs. There's just things happening on chain all of a sudden that the blockchain becomes more alive again. And then the market starts to look at that and says, oh, wow, Ethereum did $30 million in fees. And so all of a sudden now the fundamental analysis changes. Now the discount cash flow changes. And so you see how like the reflexivity, and it goes in both directions, right? If the price goes down, you see on-chain activity typically dropping on the other side as well. But it becomes really reflexive because all of a sudden CNBC will start talking about Ethereum. Look at how many fees it's doing. And then that brings in more people that are on chain. All of a sudden it becomes like this feedback loop. And we see this in crypto on the upside and also, on the downside. But yeah, curious if you have anything to add to that.
Yeah, look, I have been a public critic of the efficient market hypothesis ever since I completed my first year of undergrad back in 2008. Because after the bankruptcy of Lehman Brothers, I didn't see any efficient market hypothesis happening in real play. So I've been a critic of efficient market hypothesis ever since I've been exposed to that theory in my first year of undergrad, which coincided with the 2008 global financial crisis. And over time, when I got exposed to George Soros's theory, I tend to agree that that could be a good framework to make sense about price movements. So I agree that that would follow towards this asset class as well. I'm curious, do you want to zoom out a little bit? I want to see what's being like, let's go max. Okay.
Yeah, again, we're looking
you're
at
right.
price.
Look at that, look at that
price.
big run in and that big spike, after Jan 2021.
This was the fees got to $231 million in one day of fees. I want to say, and this is related to how Ethereum has a limited supply of block space. And so when there's a ton of demand all at once, people just pay massive fees to do things on chain. I want to say that was NFT mint, a very popular NFT mint, and everybody was trying to mint that NFT, and that drove the price of gas. Unbelievable.
I was more so referring to the one before July 2021. Like that.
Okay.
This
one.
Yeah, this one is like perfectly fits into what you were suggesting, that a lot of fees, but also a lot of hike in the price as well. But yeah, like we're nowhere near the fees. And I wonder, it's just an open-ended question. We might need to do more research and come back in later episodes to discuss about this. But I wonder how big of an impact the Ethereum merge has on the fees and also the prices. Like it'll be good to see a before merge and after merge analysis of it.
It's hard to say on the fees, but let's actually pull that up because that is a very fascinating topic. So now I'm just toggling this we're going to look at fees, so on-chain daily fees, as well as token incentives, and this tells a pretty interesting story here. So
before Michael go further into it, this is where my being a professor comes into play because I know what questions my students ask me. I think it's pretty clear, even if somebody's new to crypto, when somebody does a transaction, people do the fees. Token incentives. From this context, when we look at the token incentives chart, it'll be great for our listeners that you tell us what does token incentives actually mean, given this chart that we are seeing.
Thanks for pausing me there. So token incentives it's really what blockchains use to incentivize service providers to provide those services to the network. And so you can think of the token incentives as almost like the network, like paying out its equity, almost like how a startup company would pay out equity to the early employees. And so with Ethereum, they're issuing tokens to the network of validators. There's, I think, over 900,000 validators globally for Ethereum. And so for them to provide services to the network, there needs to be an economic incentive for them to do that. And so the network programmatically issues tokens in pro rata to the amount of stake that these validators have put up to provide those services. And then, this is where the token economics comes into play, where you're actually inflating the supply of Ethereum by issuing those tokens out. And so there's also this mechanism with the monetary policy with Ethereum, where as more users come into the network and they're paying for services in ETH to do that, the network automatically burns it's usually between 85 and 90% of that fee. So that's offsetting the new issuance, right? And so Ethereum essentially becomes profitable on days when the network does more fees
Amazing.
than token incentives. And that's really what we're looking at here. This is daily fees versus token incentives. And this tells a super interesting story, because if you zoom all the way out on this, you can see that the token incentives were way, way, way higher before the merge. I'm going to just...
That's a great insight to see over here, thanks to Token Terminal, yeah.
And so, yeah, Token Terminal makes this super easy to observe, but the proof of work merge happened right here.
Yeah.
Right? So beginning of September, it's been over a year now. And what this did was it changed the monetary policy of the network. What this tells me is that the network was overpaying proof of work miners in a massive way. They were overpaying. They were issuing way too much of the supply. They were giving away too much equity to proof of work miners in some regards, because the miners have an operating expense. They have to pay for machines. They have to pay for electricity. And that played into that to some degree. But when the network transitioned to proof of stake, now the people that are providing those services, they don't have the same operating expense as the miners had. So they're getting paid much less as a result. It's actually like over an 80% reduction. And if you think of token incentives as an expense to the network, you can talk about that, then you've reduced your operating expenses by 80% as a result of moving to proof of stake. And it's really the only L1 that's kind of gotten to that state where the yield that those validators are earning is actually a real yield, because it's coming from those user fees and not just inflation of the token at this point. So
I think this is an amazing thing to share for people out there. Basically what Michael summarized over here, which is amazingly explained, and you should rewind forward if you don't understand this concept, but definitely understand this. What Michael just explained in terms of token incentives is what we call, and what you all would probably know, is staking rewards. So this is very important to understand. And I think this is great to see, what changed after the merge. And this is great visualization to see the changes there.
Yeah, and if people are, listening to this, and it goes out through the DeFi Report Substack channel, I would just recommend when Shiv and I going forward, we're going to have these weekly segments called Going On Chain. As we introed in here, these are the moments where you really want to be watching this on YouTube, because we're pulling up the dash. We're kind of going through this. So if you're listening, not as entertaining, hopefully we can, you could still follow along with what we're getting.
We are pretty entertaining.
This is definitely a visual exercise here. And then, we could look at this from another angle. We could look at the supply side fees, right? So here we're looking at total fees. So total fees are these green bars. And then the supply side fees are the purple bars. And that's essentially the margin of the fee that gets paid to the validators. So that the difference between that 9.6 million that we see the network did yesterday in terms of total fees, just over $1 million of that was paid to the validators. So now you might be asking, well, what happened to the other $8.5 million? Those are the tokens that get automatically burned, and that's acting as a stock buyback, right? So now that's offsetting these token incentives, the issuance that we just displayed. And that's how, this is the token economic exercise that analysts are going through to figure out, as the network, is there a feedback loop between network usage and then scarcity of the token, utility of the token, network usage, and scarcity. And you're looking for that flywheel, where as the network gets used more, this sort of like mechanism where more tokens are coming off the market, or the token is potentially becoming more scarce. And it's kind of like, you think about it, if Amazon like automatically bought back more of its shares as it sold more products and services in an automatic way, that's kind of how this is functioning.
So look, Michael, I think this is great. For our first edition of Going On Chain with Token Terminal, we've covered 3 very good points about, the different ways that one can track the metrics to understand the fundamental analysis over here. So I think this is a lot of value. Plus, I've got a bias to do things in 3, because I've got 2 other brothers, so 3 things, and we've covered 3. So I think this was great. So Michael, this was amazing. The first Going On Chain with Token Terminal. Thanks a lot for doing this, Michael.
Yeah, thanks for guiding me, Shiv. Super keen on sharing more insights going forward. This is just kind of a little glimpse into like how we would look at something like Ethereum, but we're going to be sharing different, business model analysis. We'll be looking at L2s and value capture through the tech stack moving forward. So excited to pick it up again next week.
Look, Michael, pleasure is all mine, because now for a lot of my existing students and for a lot of future students that will be listening to our podcast on our respected channels and on the rundown as well. They've got two professors to lean on now, Professor Shiv and Professor Michael. I'm glad we're getting extra resources to get more people to learn about fundamental analysis, which is important. No shilling, no clickbait, just pure fundamental analysis on the world's first crypto fundamentals educational podcast, The Rundown. Before we sign off, Michael, what can people expect for next week's episode?
Next week's episode, a little bit of the same. So, of course, we're always going to talk about things that are happening in the markets, news, topical items. And for next week, we're going to do like a little bit of an intro into the L2s. So we're going to get into the business model of layer 2s. Ethereum is scaling. We've observed the number of transactions on L2s continue to pick up. And so it's really important to understand, like, economically, what does that mean for L2s? Also, what does it mean for Ethereum? And so we'll be diving into a little bit of that starting next week.
Amazing, Michael. Now, before, again, sign off, I know I've been saying this line a lot, but none of this that we are saying when it comes to talking about Ethereum, talking about Bitcoin, talking about layer 2 in the future, we are not paid by these blockchain networks to say these things, and none of what we say is a financial advice as well. This is our humble, educated analysis on it, so please don't take this as investment advice, and also be assured that we are not getting paid to shill any blockchain network or token. We are thankful that we got Michael, and we've got Token Terminal giving us their very rich data in helping us showcase good fundamentals in crypto.
Yeah, I think that's a great way to wrap it up. Thanks, everybody, and we'll see everybody next week.
Amazing. See you guys.